Hello everybody and welcome to Commodity Culture, where we break down the commodity space for both new and experienced investors. My name is Jesse Day. Before we get started, standard disclaimer, nothing here is investing advice. Do your own due diligence. And today's guest is the CEO of Wealth Research Group, a newsletter focused on investment principles, stocks, gold, and passive income. It's Lior Gantz. Welcome back to the show.
Thanks for having me back.
Yeah, happy to have you back. I want to start with the debt ceiling because this has been a big debacle. We're seeing a lot of things going on FinTwit and in the media. It seems like a circus at the moment. So I'm wondering, is this whole thing all just political theater? Are they just actors on a stage playing this whole thing out? Or could the U.S. actually default on its debt? And what would be the consequences of that happening?
Okay, so I give a default a very low probability, less than 1%, that we see any sort of default. But not because this is political theater. I think this time around, the debt ceiling is a real issue. And the fact that the Democrats and the Republicans are arguing is actually a positive thing, because I think that the 2024 elections and the next few years will be a lot about fiscal responsibility, not about balancing the budget or anything substantial that you can accomplish. I don't think that's in the horizon. But I do think that with inflation so high and top of mind for so many people, I think that this time you will see it being a more important topic in this decade in the United States. I think that what is happening around the world, you can see it in France in the last few months, where they raised the pensions from 62 to 64 years old. And in France, pensions are literally sacred. So the reason that they've done that, and the reason that this is happening, is because of demographic shifts around the globe, new aging patterns, and essentially the end of an era of hyper-globalization that we've been in since the fall of the Soviet Union and into the pandemic. So I would say the last 30 years here have been sort of an era that should not have existed, but existed only because of American think tanks that proceeded with these policies. I think that if you look at the debt ceiling, it will be raised. And I think that what people should think about is not that it's political theater, because it's not this time around. It is more meaty and juicy and important. And I think that it will be a subject that will be essential for American politics in the next few years, because inflation has fundamentally changed, and it's staying with us. You can see it in the fact that unemployment has stayed really low, essentially at all-time lows, even when the Fed has raised interest rates significantly, and even when big tech is laying off thousands and tens of thousands of employees, which have no problem to then find new places to work. So my long answer is, I don't think that the debt ceiling will become a real issue. The consequences, if it does, there's basically two ways to look at it. You can default towards foreign creditors. That would be a nuclear solution. In that scenario, what I would say is the world is completely changed, because the risk-free asset that everyone in the world is working based off of, which is treasury debt, will no longer exist. So we're literally resetting the entire financial system 20 times worse than the Great Depression. It's the end of the world. So that's one scenario. The second scenario is defaulting within. Not paying salaries, Medicare, Medicaid, Social Security. Essentially, the government is defaulting towards its own obligations. I don't see that happening, and I don't think that is the right solution to the problem. I think that floating this problem, as they do right now, is important. I think that there are many investors that are hedging for that issue, but I don't think it will actually happen.
So you mentioned there you think inflation is going to be more persistent. Is this a structural sort of inflation? And what do you see that could potentially bring it down? How long do you think we're in for this inflationary period?
Okay. Yeah, I think it's sticky. I think it's persistent. I think that it will take a long time to bring it back down. And that's the reason is because of stimulus for essentially 12 to 13 years. And it finally, during the pandemic years, it did trickle down. The trickle down effect that we heard about in 2011 and never materialized. And then it did. And so the public is loaded with cash. The money market accounts are flooded with, I think, over $5 trillion right now. Liquidity is abundant in the private sector. Household wealth is really high. Even though that we did see, and we are seeing, decline in home prices and in valuations of stocks. In general, I would say that we are in a very good situation, and definitely everyone is employed. So I think that between the restructuring of supply chains around the world, and essentially what we're doing is we're taking supply chains that already existed and then we're just replicating them. Think of a house that's fully furnished and then you just decide on a whim, hey, let's just refurnish it again. You're just spending money on something that's already there. And that's a very costly and inflationary situation. Secondly, demographics are creating a situation where there's a shortage of workers in the Western world because of mass retirements in the boomer community, and not enough people to occupy those vacancies. So I think that you have salary inflation, and then to couple, to top it all off, I think that you have a situation in terms of demand for products and services that shifted because of the pandemic and is now coming back towards services, which are far more inflationary than products. Now, those three, along with the problems we have in the energy sector in Europe, are creating a very persistent inflationary landscape, and it will take a few years. This is a 5 to 6 year story before it goes back down to the 2% level. If it does, it could stay very persistent at the 2.5 to 3%.
So your newsletter focuses a lot on geopolitics and energy. So this is a bit of a broader question, but I'm wondering where you see the geopolitical chessboard arranged at this point in time regarding both the conflict in Ukraine, what many see as a growing threat from China and their alliance with Russia, and the BRICS nations. How do you see that positioned, and how do you see that unfolding moving forward?
So if we go back quickly to the early 90s, when the Soviet Union collapsed, the Berlin Wall fell, and we literally ended the Cold War. The only obstacle in America's way had been removed, and at that point, globalization should have actually ended, and a new world order should have emerged in the early 90s. Because it didn't, and because we entered hyperglobalization, essentially a period that should not have really existed. There was no enemy for the United States, and they should have reprioritized, but they didn't. We created a situation that we're in today, where China has been able to grow as a challenger, and instead of focusing on that early on in the 90s and contending that then and there, and staying the only hegemonic power and the dominant power, America didn't see it coming. And by the time 2011 came by, Obama started to really understand that, man, focusing on the Middle East, focusing on this war in Iraq and in Afghanistan is not where America should look for threats. It should look for threats in the South China Sea, etc. He started to pull back and refocus on Asia, Taiwan, the South China Sea, and China. Then, obviously, Trump came in and really focused on China. Tariffs, the UN speech, which basically the US speech is, hey, we're done being the policemen of the world. We're done with the Bretton Woods agreements, and we're restructuring everything. And then the pandemic happened. The pandemic is literally the best expression of peak globalization, because you had a global problem that should have united all nations in order to solve it, and instead you saw finger pointing and different angles. You saw Australia and New Zealand doing one thing, Sweden doing an altogether other thing, China doing one thing, and then the United States doing another. So I think that peaked where globalization, supply chains, etc., and everything is getting reset. We are in a major reset problem, and all the pent-up inflation has been bursting. So the BRICS are an association. They're not a union. They're not a real entity. They're just like a thinking tank of these countries, which is all good and well, but they really have nothing substantial right now to de-dollarize. And I know it's, everyone likes to say de-dollarization, and it's but it's just not there. The dollar remains so far away and above everything else. It's not perfect at all. It's almost like a broken marriage where the divorce would look far worse. So no, I don't think that the BRICS have anything to offer in terms of competing currencies. The Chinese have no idea what it is to run a free currency, and all the other ones have they have nothing to offer of substance. I think that when you look at China is facing a tremendous threat within. Their demographics are in a real problem because of 336 million abortions during the one-child policy. They're a nation where culturally families have one child, and they cannot support what they've created. And just think about this. It's projected that they will go from the 1.3, 1.4, wherever they are right now, and nobody obviously actually knows. They will half in population without famines, without droughts, without any natural disaster causing it. They are just going to collapse in demographics, and that's their main problem that they're facing. Will they challenge the United States? In many ways, they will. They sure are getting bigger. Their economy is getting bigger. Their military is getting bigger. By 2027, I believe they will have GDP-wise the largest economy in the world, and by 2035 they will have the largest military budget. Opposing to that are the Japanese, which are waking up from hibernation, and they are budgeting, I think, the largest military 5-year plan in human history. So they are gearing up to a potential escalation in the South China Sea, and that escalation and that industrialization of Japan is what's causing its stock market to hit an all-time high after 33 years. Essentially, you're seeing the same thing with Germany. The DAX is at an all-time high, and the reason is that they have a militarization plan in Europe because of what Russia has done. So when you ask about the war in Europe, Russia is a country that has a lot of issues on how to protect its borders. That's why NATO's increasing towards it is really problematic for it, because invading Russia is really easy with soldiers. It has the topography that is, every Russian learns about the Mongols and the Tataris and everyone that has invaded their country and raided it and raped their women, etc. So they're very, very scared, and I think that this war is going to last a while longer. And the problem is, if they will start losing, if the Ukrainians will win, this could get even more dangerous. So that's the problem. If the Russians win, then they advance into Ukraine, and then they have more aspirations, and this war lasts longer. If the Russians start to lose, this war can get dangerous. So none of these are good.
Great breakdown, and I love the practical approach to everything. No hyperbole. I like the description of the U.S. dollar as a broken marriage where the divorce looks worse. Very, very well said. So I wanted to get your thoughts on gold here. It's touched all-time highs and is hovering around the $1,900 to $2,000 level, showing quite a bit of resilience and strength. Are we headed to all-time highs this year, in your opinion?
I don't think this year. I mean, we've had an all-time high this year. So I don't think we're going to see it again. The reason is I think that interest rates are going to stay higher for longer. And I don't think that the Fed is going to capitulate anytime soon on interest rates. So to me, it looks more like a 2024 story in terms of all-time highs. I do think that we are going into all-time highs. We're actually going much higher for gold in the next few years, but I don't know if it's going to happen this year. Interest rates have not peaked yet, in my opinion. I think we may even see one more rate hike, which takes us to the 525 to 550 range. And I do think the year will end at around 5% or 4.75. These are very high interest rates, and the Fed, its playbook, like Bernanke had the Great Depression, which made them go all out in 2008. Powell has the mid-70s. The mid-70s are his arch enemy. And in the mid-70s, basically, the Fed thought inflation was solved. They eased, and then inflation erupted. And that's everything that he thinks about. And then he thinks about how Volcker ended it, creating a miserable recession, and countries went belly up, and it was a real problem in 1981. So I think that he's trying to avoid that. And the way you avoid it is you just do a lot of telegraphing and messaging in advance of what you plan to do, and try to see if the market believes you. And if it does, it's already self-correcting even before you do anything, and you don't have to do everything. So that's one thing that's very different from the Volcker era. The second thing that I think is interesting is that we are in a situation where the gold to S&P 500 ratio is at a 123-year low. So even with nominal all-time highs for gold, it's extremely cheap when you look at it from that perspective. And that perspective is the perspective that you should think about if you're investing in silver or in mining equities, because that's the real turn-on for silver and mining equities. When the S&P 500 when the gold to S&P 500 ratio hits these lows, it bounces back. And when it does, those are the moves that you're looking for. So in the last 11 years, we've actually gone from pretty much the median on the gold to S&P 500 to now 123-year low. So it's a really interesting phenomenon, but it is certainly here. And I think that that is the driving force behind more gains for gold's nominal price. I do have to say that gold is trading for an all-time high in about 80 currencies right now. So it's in a raging bull market. It's just that in dollar terms it's not, but everybody else around the world, the other 95% of the population of this planet, is seeing gold at an all-time high.
So given higher rates for longer, where do you think investors should be positioned at the moment? Is this a time to be in short-term treasury bills, in money market accounts, just sit on the sidelines? Are there any opportunities you see for capital appreciation here? Is it a time to stack silver and gold bullion? What are your thoughts?
Well, first of all, my personal portfolio, A to Z, is available at wealthresearchgroup.com/portfolio. That's literally my portfolio, excluding any and all volatile companies. So my bread and butter, my core portfolio is there. You can download it. It's comprised of about 50 companies. What we're doing right now is we're actually concentrating it to 17 companies. And if you're a reader of the newsletter, then it's literally these days I am publishing that list of 17. So I do think that there are companies that are worth adding or building, etc., but not a lot. This is not a buy the NASDAQ and sit on it for 10 years, or buy the S&P and sit on it for 5 years. We're not in a broad stock market bull market. We're not in a growth period for the American enterprise system. And contrary to that, we are in a renaissance for fixed income. So I invest a lot in debt, a lot. For most people right now in a money market account, it's extremely appealing, 5-6%, whatever it's paying right now. In debt, you can get between 10 and 12%, and I've just finished a call last night with a venture with a tech fund that is gonna do debt at 16%. So I haven't said yes to that, but just to give you an idea of how much interest rates have risen. So if you can lock a 12% for 3 years or a 10% for 3 years, what are you doing in the stock market? What are you even looking for in the stock market? It's not attractive compared to the alternatives. So one thing I think that people should look at are debt funds, debt opportunities, anything that has to do with fixed income and with interest rates, not treasuries, but private sector debt, because there are distressed real estate opportunities that need to refinance, and the banks sometimes they just plain out say no, and the fund manager doesn't want to sell at a loss, and if he can refinance at 10 to 12%, he will. And sometimes these projects are 90% occupied and are in positive cash flow, so there's no real distress. There's just the sellers want want to get better returns, and the buyers are saying these sellers are going to sell cheap. So you have a frozen real estate market, and that's great for anyone that's in the refinance business. So if you're accredited, look for the highest quality debt funds. If you're not accredited, look for debt funds that are micro doses, and there are many opportunities like that in the United States. I think that's one thing that's really interesting. Secondly, is that portfolio of 17 companies out of that 50. So if you download that and then follow our newsletter, I think that what's being overlooked is companies that are managed by Steve Jobs lookalikes, Elon Musk lookalikes. The highest quality CEOs in the world. Their stock looks like the S&P 500. It trades in tandem, but there are major differences because some companies are able to flourish through this and actually evolve and grow. So that's number two. High top quality companies. 3 is real estate. I think that real estate holds opportunity. It's just not general opportunities. If you're able to find specific ones, then there are things that you can do. But I do think that we have time. Real estate is no rush, at least in my book. In terms of precious metals, I actually like silver more than gold right now. The reason is I think that the dollar is going to get weaker in the months ahead and in the years ahead. The dollar was very strong during the last 10 years because of big tech and because of the lousy environment in emerging markets. It just drew a lot of money into the United States, and I think that this is shifting now away from the United States and into Europe and Asia, and that is not good for the DXY, and I think that is really good for silver. So I think silver is more interesting than gold right now by far, but to me 80% is now going into debt. If I can earn 10 to 12% fixed income, then nothing else is really worth the risk at this point.
Well, thank you so much for joining us today, Lior. For those who want to learn more, could you tell us about Wealth Research Group? And if there's anywhere else you want to direct people online, feel free to do that as well.
Yeah, wealthresearchgroup.com. On the homepage, you can subscribe to the free newsletter. I do think that we created a special report for your viewers on a very interesting topic, and that is World War III And what I want to tell you is it's not the battleground you think it is. So if you go to wealthresearchgroup.com/space, I think that you'll be very interested in what's going on right now in lower orbit, where I think the next big battleground will be fought.
Very interesting. I'll put a link in the description so people can check that out. Thank you once again, Lior, for coming on and sharing your knowledge with our audience.
Thank you for having me.
Commodity Culture is a series on commodities and natural resources. If you would like to see more, be sure to subscribe and hit the bell notification so you're always up to date with the latest episodes.